Why would you want to work blood, sweat, and tears to build up your business, work your whole life to build the equity in your business, and then at the end of the day, when you're ready to sell, you don't properly plan it so you can prevent the astronomical taxes?
It's an evil world we live in.
That's why in this video I want to let you know about Section 1202 of the Internal Revenue Code and how certain small business owners can exclude up to $10 million in capital gains tax. In this video, I'm going to go over the requirements.
They never heard of Matumbo. These are lucrative assets, golden words that are mumbled.
So let's talk about the key takeaways. The first key takeaway, which we talked about a little, is that within the Internal Revenue Code, Section 1202 allows certain small business stock to be able to exclude capital gains from federal tax. There are limitations to it. And these limitations are the greater of either $10 million or 10 times the adjusted basis of that stock. So let's give a little example. What is a basis? Basis is the amount of money that you put into a company to be able to allow it to have resources to acquire assets and leverage those assets with liabilities to be able to expand and provide the products and services that you want. So let's say you contributed $100,000 to a corporation to be able to acquire assets and then leverage that balance sheet to be able to grow more exponentially. Well, that $100,000 will then have to be multiplied by 10, and then that'll give you the federal exclusion that you could get from Section 1202 within that formula and that equation, which if the example is 100,000 times 10, that's $1 million. So you could either, and if you, let's say you sell that business for $3 million, well, you could either exclude up to $10 million of capital gains from the sales price, adjusted for your cost basis, or 10 times the cost basis, which the higher between 1 million from the $100,000 of basis multiplied by 10, or 10 million, obviously 10 million is greater, so you're gonna have pretty much the whole sales price excluded from capital gains. This portion of the tax code provides incentives for non-corporate taxpayers, and these eligible non-corporate taxpayers are 1, individuals, 2, trusts, and 3, estates, and 4 as well. Let me aggregate to that, certain flow-through entities, what they call 1065 partnership business structures, or S corporations, 1120S entities recognized by the IRS. But we'll go to that a little bit later. So now I want to talk about a little bit about the requirements to be eligible for Section 1202. The first one is that the original stock that was issued, you have to have acquired it, and it has to be issued by a C corporation. Moreover, there's certain industries and businesses that don't qualify for this. So restaurants, hotels, farmers, mining companies, real estate companies, and a couple other more. Second, it was originally issued after August 10, 1993, and it was issued for money or property not including stocks, or as compensation for a service rendered or services rendered. Third, on the date when the stock was issued and immediately thereafter, the gross amount of assets was less than 50 million. Fourth, the use of at least 80% of the assets within the company have been used for qualified small businesses. That's why it's imperative that you get a qualified CPA with experience with this. It's integral that you have the proper structure in place and know if your business and you qualify for this Section 1202. Especially if you know that the valuation of your company is going to be more than $1 million. Lastly, given the fiduciary obligation that we uphold ourselves at this CPA when we service our clients, we strongly feel and believe that we have the credentials, passion, and niche experience to be able to service you with these needs. And click this link below. Also, comment, share, and subscribe.